So, Meesho is going public. The company is set to raise 5,421 crore rupees through its IPO, which opens December 3rd. That's tomorrow. It's quite the moment for e-commerce. The first horizontal player, that's a platform that sells across multiple product categories, is listing in India. In fact, it's beating Flipkart to the markets, despite starting nearly a decade later. But here's the thing, Meesho isn't trying to be Amazon or Flipkart. While those giants spent billions on building warehouses and logistics networks, Meesho has always stayed asset-light. Also, it went after Tier 3 towns with average order values as low as 273 rupees, which is a third of the industry norm. And while Snapdeal and ShopClues have failed at this exact playbook, Meesho claims it has cracked the code by modeling itself on China's Pinduoduo and Southeast Asia's Shopee, not America's e-commerce playbook. The timing's of course interesting. Quick commerce is exploding and investors are hungry for successful consumer tech stories. But they should also be wary because no horizontal e-commerce player in India has turned a profit in 15 years. Meesho of course says it's different. Cash flow positive, capital efficient, and growing at a rate that's several multiples of the industry. Is that enough? Well, ET's Startups Chief Samida Sharma and Pranav Mukul help us understand by talking to Vidit Atre, Meesho's CEO. Post that, I do a sort of debrief on Vidit's assertions with Samida. Listen on, it's Tuesday, the 2nd of December. I'm Anirban Chaudhary. This is the Morning Brief. First up, the interview. Here's Samida.
How difficult was it to go into the market as a horizontal e-commerce player, considering the history hasn't really been great? You obviously have large e-commerce players who've still not made profits, more than 15 years after being operational, having raised tons of investor capital. How difficult was it to convince the public market investors that this business will eventually sort of make money?
I think because we have now spent 10 years, people have enough data in the business to look at how we have built our business. So we've been very capital efficient. Business has always been very, very asset light. We continue to grow at a very good pace. The first 6 months of this financial year, our orders grew by 50% plus, NMV grew by 44% year on year. There's still a lot of growth in our ecosystem. For the last few years, we have also been free cash flow positive. So people can also see the financial discipline there. And that's why I think people believed in our story.
You've obviously always wanted to be asset light, and that is something that you've always spoken about. When you look at an Amazon and Flipkart, two of your sort of large competitors, they have really invested behind infrastructure and supply chain, etc. So has that question ever come up that to build mammoth scale e-commerce you do need some sort of a infrastructure, warehousing, all of those things to be tied up to the business and be full stack that way?
Yes, I think I can't comment on anyone else, but if you see, we today have the highest order volumes for any e-commerce platform. We have the highest Google transacting user base, and we are even today asset light in every way possible. So we can keep scaling our business, keep compounding on this while maintaining the asset light profile. And people also get a lot of confidence that you can see the same thing happen globally, right? They look at players like Pinduoduo in China, you look at players like Shopee in Southeast Asia. Like again, very, very similar way of doing it. They scale quite a lot, but they are asset light marketplaces in a very similar way as us. So there's precedence around it. People have seen our history. We have got to scale while staying asset light and capital efficient. So there's no reason that would change.
Yeah, so within I was just going through your latest numbers for April, September. Couple of things sort of tie up. Of course, EBITDA losses have increased. GMV has grown faster than NMV. What's the play here now? Suddenly, why has this happened? Are you sort of, very intentionally prioritizing growth over your bottom line improvement, which you had managed up till a point till last year?
Yeah.
But why this sudden deterioration?
I think what has happened is, especially over the last 18 months, we have seen our value proposition become even stronger. Like our was almost scaling up, our prices have become even better, and we saw very good payback periods on our marketing spend. And we believe as a company, I think we are very, very disciplined that way, that as long as payback periods continue to be attractive, we will spend, because it's better to acquire your steady state annual transacting user base in 3 or 5 years rather than doing in 10 years, because then you can achieve your steady state potential around frequency and bottom line much sooner than later. But as long as the payback periods are strong, if at any point in time we see that the payback periods are not as strong as they were earlier, we will not.
But say for the next couple of years, what will drive growth for Meesho?
I think the levers would be similar, which is first keep growing our annual transacting user base. Our last 12 months ending September, we had 23 crore customers, growing still at a very good pace year on year. So like our focus is to keep scaling that. A big focus area is to kind of keep adding more and more products, making stuff even more affordable as we make our entire ecosystem more efficient. As we do that, more categories scale up. Frequency on the platform will keep increasing for our user base, which has continued to happen for the last few years. If you see our frequency now almost 10 per year, used to be about 7.5 2 years ago. So that will continue to rise. So I think all of this will be a large driver for our growth for the next few years.
Understood. And so, in terms of your bottom line, sort of, what would the trajectory be like? We've seen now a couple of new age companies sort of going out and doing follow-on round in the public markets. Especially loss-making ones. After having burned through most of what they raised in the IPO. I mean, to that extent, how do you sort of address that issue? Is this investment towards growth that you're making for the short term, or will it continue this way where we are seeing your losses sort of increasing?
Yeah, and live on this particular point, which is why as a company, we always optimize for free cash flow, right? Because at the end of the day, what matters is, are you burning money or are you adding money to your bank account? Last 2 years, we do free cash flow positive. Okay? And as long as we are free cash flow positive, there's no need for us to kind of dilute our shareholders at any point in time in the future. And we don't see this profile changing even going forward. We will continue to focus on growth while optimizing for free cash flow as the most important metric. And as long as that's happening, we will only add money to a bank account.
Okay. Also, just wanted to understand, the pricing of the issue. Now, you last raised at about, your private round valuation was about 5 billion. On the upper end of the issue price, it would be slightly higher, around 5.8. What is the kind of feedback you got? Because there was a time when, and I know you'll say that, we never gave any pricing. It was the media which had written about, 8 and 10 billion. But has there been some sort of pullback or, adjustment in terms of the pricing expectations for the IPO?
I think the price discovery always happens when you go and speak to investors. And that's what we did. We are very clear. I think our principle has been very clear. We don't optimize for any short-term goal. We take a long-term view to this problem as well. We want to get the right shareholders on board, the right domestic shareholders, the right foreign shareholders, people who believe in the story for the long term. And we wanted to get to a price where everyone is attracted to the company, to come on board and make money over the long run. As a company, we always ensured that our investors make money, which is why you see most of our investors have stuck around for the longest while. Our goal is to do that for the incoming investors as well. That's basically the thing that we're optimizing for when we looked at pricing, and we believed that at this pricing we have seen like the right people showing interest. So that's been the principle around, actually, nothing else.
And you also cut down your OFS size. What was the reason for that?
So actually, like you have to do a minimum 10% float for an IPO, right? Beside the primary that we are raising, the remaining we had to ask our existing shareholders to sell, otherwise you can't
Right.
meet the and one. So it's like the bare minimum that we had to do, which is why we are doing this. Most of our shareholders, people who came even in the earliest rounds, are still very, very optimistic. They see our growth rates, they see our performance in the near term, and they want to stay around and basically compound their shareholder, like their value over time. So that's basically the primary reason why OFS reduced as well, because we just wanted to meet the 10% float size.
Just wanted to double click on where the next phase of growth will come from, and I think it's pretty important, and something that I've also spoken to a bunch of people in the public markets on their view on Meesho. Would you need to diversify, say, go back into doing some of the experiments that you did during COVID, which was grocery, adding FMCG, all of that diversification play? Would that come in for you to kind of go from whatever you are currently to sort of building a larger business, say 3 to 5 years down the line?
We have continued to focus on making more and more products affordable. So if you see, even in branded FMCG products, Meesho Mall has been scaling well. A lot of FMCG brands are there and they've been enjoying success and they're investing more and more there. And even there, by the way, we are working on creating more affordable selection
Okay.
for all these brands. We don't sell like stuff that you would see on other platforms. All of our selection is very, very focused on affordability. So we will do affordability across all kinds of categories. Some of the products we already sell there, we can classify them in grocery. Some of the products are beyond grocery. Like last 2 years, as you see, home and kitchen used to be 10% of our sales 2 years ago, 10% of our orders. The recent number is about 19%, so doubled. So categories which keep scaling: grocery, home and kitchen, FMCG, and it is continuously happening. And the common theme across all these is affordability.
What is the overall size of this market?
I think here, if you want to see, I think the perspective is clear across emerging markets. You see China, Southeast Asia, Latin America, the largest e-commerce business models in steady state are value commerce. We believe India is no different. India also has same kind of per capita incomes. People have the same aspirations. People want to do more. So I think the opportunity is quite large.
Okay. And have you at all spoken about any inorganic growth or acquisitions going forward? And can you detail a few of the things you're doing in this Horizon 2? I mean, we've spoken about it briefly, but can you just detail that a little more?
Yes, so Sanjeev is also here. I'll ask him to talk about
Hi.
stuff they do.
So, one of the big bets that we're taking on the Horizon 2 initiative is on AI. Now, AI has now reached a state where you can do conversations with AI, right? Like
Yeah.
the current customer support side, large part of our customer support chats and decent percentage of our customer support voice calls is already handled by AI entirely. So that technology, AI, we are using it effectively. So as we continue to go deeper into rural India, it's also more important to make the experience simpler for our user, to help them navigate the app, help them find the right products quickly. So that is one large track that we continue to focus on. About 75% of the orders today come from ranking and recommendations algorithms, right? Like the feed that ranking recommendation algorithm generates. So I think it's also extremely important to continue to upgrade them. So this tech continues to evolve pretty fast. The second Horizon 2 initiative is financial services and whether you
Yeah. Yeah.
So I think there, if you look at all the other markets as well, as I said, China, Southeast Asia, Latin America, you'll also see the largest value commerce platforms also build substantial financial services businesses.
Right.
Recent Shopee is done with C-Money, Mercado in Latin America, Taobao was the first value commerce platform in China,
China.
and then The reason that happens is that a lot of people have data on the top 30, 50, 70 million people in the country. Very few people have data beyond that. And now, with us having the highest annual transacting user base and so many orders on these consumers and businesses, we can really help all of these customers get access to financial services products that otherwise they will not get access to. So that's a big focus area there. We started with the seller lending platform for our sellers to get access to working capital loans. We also launched a BNPL product working with some of our partners. So that's the journey. I think we just started on this till very early stage, but we believe the opportunity there is quite large. Knowing the problem within India and looking at some of these examples outside.
How large is your financial services play at this point with it, and where do you see it going?
Again, I don't think we've disclosed some of these numbers yet, but
Okay.
I would say it's still early. It's not like big enough that we kind of go and focus on scaling. We're still experimenting with few things, getting the product right. When we feel we are there, we will scale it. Like the last two things we had in our Horizon 2 buckets were Valmo and Content Pop. And once we got like clarity around the product, then we scale these products really fast. We don't take time after that.
Next, I speak to Samidha to understand the fine print. Is she convinced about Meesho's story? Let's go with your top takeaways from the interview with Vidit.
So it's pretty clear that Vidit is differentiating himself from all of the incumbents and in the larger horizontal e-tailers, whether it's Flipkart and Amazon, by sort of making sure that he is not building and spending on infrastructure and logistics and staying asset light. And also his model of targeting value focused customers. That is something that he has stayed on with ever since he started the business. So he basically is clear that his pitch to investors is that he is only focusing on the tier 3 and below in terms of his customer base. So he's stuck to that as his USP as he's going into his IPO, thereby differentiating himself from all of the legacy players that have existed in the e-commerce space. Anirban.
Got it. Tell me, so when it comes to value based e commerce,
Right.
other players like Snapdeal and ShopClues, they haven't really succeeded. Why do you think Meesho would work?
So, here, let me take you back to how e commerce kind of evolved in the past 10 to 12 years, right? Snapdeal was actually competing with Amazon and Flipkart back in the day to raise some 1.8 billion. And ShopClues also, not directly, but did raise about 250, $300 million. Now, if you look at the playbook for Meesho, it's from the very beginning not wanted to compete with Amazon and Flipkart, which is where the differentiation lies here. When they started as a WhatsApp reseller, Meesho, the idea was again to get the low ASP, as in low average ticket size items onto the platform through their sellers, which were largely women. The mistake that Snapdeal made, Anirban, was that they pitched themselves on this vanity metric of GMV, and they could never compete with an Amazon and Flipkart because it sort of became a fundraise kind of competition back then. So that way, Meesho's differentiated itself from the very beginning, and obviously the kind of capital that they raised could never justify the third or the fourth player that they became in the e-commerce space.
But talking about Meesho's business model, when Vidit sort of insists that it will stay asset light even at a massive scale, are you convinced?
So, which is why we started by asking him that what is the kind of feedback that he's getting from the public markets, because e-commerce, let's be clear, it's not a new segment. I mean, we've had players like Flipkart and Amazon become big businesses in the past 15 years and still not making money, that's the moot point here, right? So how do you convince the public market investors? But Vidit's point here is that he has kept away from the model that was adapted by the first generation of e-commerce players. And when I talk to people, there is a lot of skepticism in terms of the user base and the shopper base that he has, which is very value conscious. And therefore, having them in the long term is a challenge. Plus, the second thing which is very clear is that there's very high return rate in a business like this. I mean, this is actually from the IPO prospectus. Now, if you look their AOV across platforms, if you look at e-commerce, generally is about 850 to 1,000 bucks. For Meesho, it is as low as 273. Now, it is a challenging business, therefore, because it is a very low AOV business. And obviously, there's high returns, etc. Although in their prospectus, they say it's 7.5%. So it is still a far cry. We still have to see if this model, which they're trying to replicate, which is more like the Southeast Asian and Chinese model of Pinduoduo, that flywheel sort of kicks in, if the market is deep enough in the value segment. Also, he competes with the D-Mart, etc., and Vishal Megamart in the offline retail space. So it's still to be seen how they will make money, which hasn't happened for any of the horizontal e-commerce players in India.
Got it. Let's talk about diversifications. What do you make of Meesho's financial services story, and why is the company leaning on it as a growth story for public investors?
So I think the other thing which a lot of the public market investors will want to see is the growth continuing. I mean, he mentioned in our interview that he's still growing at about 30%. But if you look at the larger e-commerce market, it has been single digit, mostly about 8 to 10. In the best case, festive season, it'll be about 12%. So he's obviously pegging himself as this one player in the e-commerce space, which is registering about 30% growth, but also that he needs to keep compounding on that. And therefore, when we asked him about diversification, he mentioned this entire AI play and also the financial services play. Right now, it's not a scaled version for either of the two, but it does have a lot of potential because they want to do this for the customer. And I mean, think of it as lending, right? So for their merchants, the sellers on their platform, and for consumers who are buying. So it's a dual-sided kind of a play. But we don't have too many numbers right now. But I guess this is something that they will push as they go along.
Samvita, after covering e-commerce and Meesho for so many years, what about its story and its latest move to go to the markets has surprised you?
No, I think it's super interesting, Anirban, to having tracked e-commerce for 15 years. One would have thought that Flipkart will be the first horizontal e-commerce to kind of go public, and they're in the process. Meesho literally came from nowhere in 2015-16, started as a sort of a reseller largely on WhatsApp and Facebook. Facebook was an investor in them as well. But to see them go public with a very different kind of a playbook, which has actually worked in India, is quite interesting. And it also shows that the American e-commerce playbook hasn't really worked the way an Amazon worked in the US. So Flipkart was a similar kind of a comparable, right? It was an Indian business trying to do Amazon. What has actually worked in the sense that at least, it's kind of built scale and is going public is Meesho, and it's more modeled on the Chinese and the Southeast Asian e-commerce model. It's a long way to go. But also, I just want to point out that there was a time when Meesho started this zero commission and low ASP model. And later on, Flipkart and Amazon followed it. I mean, Amazon now does Amazon Bazaar, and Flipkart has Shopsy as a separate app. That just means that, you have to keep iterating rather. And someone can come in after 10 years of you having done the business and sort of challenge you on your own in the market that you've existed.
So, can Meesho pull off what no Indian e-commerce player has? An asset-light model serving value-conscious buyers, scaling financial services on the side, all while staying cash flow positive. The IPO will tell us if public markets buy this story. That's it for today. This episode was produced by Vinay Joshi and Rajas Naik, sound designed by Amrit Reggie. A new episode of The Morning Brief drops every Tuesday, Thursday, and Friday, wherever you get your podcasts. Keep listening.